You're listening to Capital Topics, episode number 60. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll discuss the investing lessons of 2023. And next, for a second topic, we'll review the book titled The Price of Time by Edward Chancellor. Enjoy! Good morning, James. How are you today?
I'm really good, François. How are you?
I'm fine, thank you. So I will start. In our last podcast, number 59, we reviewed the capital market results for 2023. And by doing so, we underlined the main economic and geopolitical events that we believe have shaped the capital market results last year. This being said, every year brings valuable lessons to investors to help us stay disciplined and focused on the long term and avoid being deterred by the short-term noise. So James, as we do every year at this time, let's review the investing lessons of 2023.
Well, 2023 was a really easy year for lessons, François. We're going to take inspiration, as we do every year, from Larry Swedroe. He's published his lessons for 2023, and I think we should review all of his 12 lessons. As our regular listeners know, he's the head of financial and economic research at Buckingham Strategic Wealth in the U.S. He's a thought leader in finance and investing. He now writes for Morningstar. We quote him often for his work in educating investors on the benefits of evidence-based investing. Over the years, he has authored or co-authored 16 books explaining in simple terms the science of investing. My colleague Cameron Passmore and I adapted his book, Playing the Winner's Game for Canadian Investors, about a decade ago.
Yeah, I can add that during almost that time, I had the privilege to go White River rafting with him and other PWL colleagues. Yeah, it was very exciting. When he came to visit our offices, he really loves rafting. I remember him telling me that every time he's on a trip somewhere new, he inquires about the rafting possibilities in the area. In any event, let's now look at the 12 lessons. He calls them the 12 lessons the market taught investors in 2023. As he mentions, many of the lessons repeat themselves from the prior year, but it seems that investors tend to forget and fail to learn them. We'll put a link to his article with the podcast. So lesson number 1 is no one is very good at consistently getting market forecasts right.
Yeah, well, we talked a lot about that in podcast number 59. I mean,
we did.
Doom and gloom at the beginning of 23 was really heavy. It's very hard to make accurate forecasts, and 2023 was no different. Larry Swedroe looked at the forecast of 23 analysts of leading investment firms for 2023 and their forecasts for the Standard & Poor 500, the largest 500 companies on the stock exchange in the U.S. It ranged from -5 to +24, with an average forecast of the market would be up +6%. And as we now know, the S&P 500 ended the year with a return in U.S. dollars of 26.4%, 23% in Canadian dollars for the full year. So that's a real difference of about 20 percentage points higher than the average estimate.
Yeah. And 2023 is not the exception for poor forecasting. The article provides a chart showing the median strategist estimates for the S&P 500 versus actual returns going back to 2018. And you can clearly see that there is a wide difference between the median estimate and the actual returns. I have calculated that the average difference over the 6 years to 2023, and it's a staggering 17.8 percentage points difference per year.
Wow, that's incredible. François, if you're trying to manage your portfolio by listening to the advice of market strategies, making forecasts, well, good luck to you, right?
Indeed.
When Warren Buffett tells us to ignore it, Larry Swedroe has been telling, and the evidence is compelling. Mm-hmm. So, as I said in our last podcast, we highlighted, the poor forecasting results. And we also highlighted that the Magnificent 7 stocks in our 2023 market review generated most of the returns in American markets. But Larry has an interesting view, and that's his lesson number 2. Perhaps the Magnificent 7 should be called the Magnificent 3. And that's basically because He agrees that, yeah, the Magnificent Seven had huge gains in 2023, but he highlights that three of them, Tesla, Google, Alphabet, and Amazon, ended the year below their 2021 closing prices. So it depends on your reference point. If you're just taking the 12 months of 23, or if you look just a little bit wider. So only three of them, Apple, Microsoft, and NVIDIA, he points out, managed to outperform the riskless 1 month T-bill that returned 3.2% over the same period.
Yeah, it's a good point he brings. We can look at the market performances through different lenses. We can certainly affirm that the S&P 500 had a superb return in 2023, but we can also say that it provided no return at all between December 31st, 2021 and December 31st, 2023, except for dividends, because the index closed at almost the same level in both years. So this leads up to lesson number 3. The valuations cannot be used to time the market.
Well, this is a classic, and you always hear these analysts doing their forecasts. Oh, the valuation of the market is stretched, and the market's due for a correction. It's a classic lesson. U.S. equity valuations were at very high levels historically at the start of 2023. So if you followed that metric, you wouldn't have invested, or you would have disinvested, right? Mm-hmm. And that was particularly true for these growth stocks. So if you had stayed on the sidelines because of that overvaluation, you would have missed out on an extraordinary gain in the markets. This is not new, going back almost 20 years now to December. Well, more than that, it's to December 1996 would put us at 26 years. When Alan Greenspan at the time was the central bank chairman in the U.S., the chairman of the Fed. And he used the term irrational exuberance, and that's been quoted ever since to explain when markets are frothy. So he was trying to warn investors about high stock valuations. And despite equity valuations being very high, when he made that speech, stock prices kept increasing for 4 more years. And during that period, the S&P index more than doubled in price.
Yeah, we should not trade on stock valuation. However, it's still a valuable information. At PWL, our research team uses stock valuation to estimate future expected returns over the long term. It's used for long term.
And we also have rebalancing, right? So if certain sectors have taken a lot of gains, we want to stay within our plan, right? So we don't just let the horses run. Now let's look at lesson number 4 that Larry shares. It takes discipline to stay the course through periods of poor performance, as all risk assets go through them.
Mm-hmm. Yeah, I think our listeners know by now that this is part of our mantra. To gain the benefits of being invested in equities, you must have discipline to stay the course in periods of good and especially in bad times. So the next lesson Larry shares with us, lesson number 5, assets with poor performance have self-healing mechanisms.
Well, the notion of self-healing mechanisms to me is really, really important for investors to learn and to abide by. He explains that when stock prices fall, investors have the reflex to sell or avoid buying, right? It's like, oh my God, it went down. Stocks went up, oh, let's buy. Well, no, they're more expensive. You should have the opposite reflex. So he reminds us that when stock prices fall, future expected returns for them are now higher. And I wrote a blog about that last year, that, the big drop in 2022, that means you got better future expected returns. Mm-hmm. So he goes on to quote Warren Buffett, and this is the classic quote that's attributed to him: "Be fearful when others are greedy, and greedy only when the others are fearful." Obviously, it's easy to say, and it's hard to do.
Yeah, totally. So moving on to lesson number 6. Even with a clear crystal ball, markets are unpredictable. The point he raises here is interesting. If you had a crystal ball at the beginning of 2023 to see the major geopolitical and economic events that would happen during the year, I think reasonably that most investors would have sold equities or stayed on the sidelines, given all the negative news.
Well, I totally agree with Larry on this, François. I mentioned it in our last podcast. Markets surprised everyone last year despite all of the negative financial news. And this leads us to his lesson number 7. Don't let politics influence investment decisions.
Yeah, it seems to me that this is sort of reflects the fact that we are faced with many elections in major global countries, including the US. With this lesson, he warns investors to be wary of our beliefs and biases because they influence our decision making and it causes mistakes in portfolio management. He reminds us to ignore our political views when making investment decisions. I feel that this is especially true for American investors who face a very difficult federal election this year.
Yeah, well, American media is omnipresent in Canada, and the polarized environment down there, you can see how people could be influenced by that.
Yeah,
but that
totally.
Again leads us to his lesson number 8. Most returns were earned over very short periods. And, again, as we went through in our last podcast, the returns in 2023, things were looking pretty bleak at the end of October. We'd given up most of the gains in equities, and the bond market was slightly negative. And they both ended up with very strong returns, by year end. So and that's, it was all generated in the last 2 months. So, this was true for 2023 for the equity markets, as I said, in the bond market. But historical evidence backs this up, and it demonstrates that market returns generally come from short bursts, short periods. And so 2023 was not unusual.
Yeah, and Larry highlights in his article that from 1927 to 2023, so that's 97 years, the S&P 500 returned an annual 10.3%. However, if you remove the 97 highest returning months during that period, the remaining 1,067 months delivered an annualized return of only 0.01%. So no returns at all. This means that only 8% of the months, the ones representing the highest returns, gave 100% of the performance over those 97 years.
That's exactly why we say you need to stay invested to capture capital market returns. It's time in the market, not timing the market.
Correct.
So it leads us to lesson number 9. Last year's winners are just as likely to be this year's dogs. This is a take on the recency bias in behavioral economics. And he reminds us that individual investors are performance chasers. They buy yesterday's winners and sell yesterday's losers. I speak about this in our most recent blog, it published on our Capital Topics website, where I address both recency bias and hindsight bias. And we can provide the link, as our listeners know, they'll find it on the Capital Topics website.
Yeah, this is a very hot topic after a phenomenal performance of U.S. markets over the last decade. A lot of investors are asking why we still invest in other equity markets. A simple answer here to me is that to remind them of the last decade in U.S. equities from the beginning of the year 2000 to the end of 2009, when the S&P 500 index generated an annualized return of negative 0.95%. Now let's look at lesson number 10. Active management is a loser's game in bull or bear market.
Well, in a couple of weeks, François, Standard & Poor's are going to produce their SPIVA report, S-P-I-V-A, and that comes out every year, and we're going to be able to confirm how active management has been able to outperform passive indexes in 2023. So don't hold your breath. I'm not expecting any surprises here. I think active managers, again, will have underperformed the indexes, particularly given the market was driven by the Magnificent Seven. So any active manager who was short weight on those positions is not going to look good in the U.S. equity market.
Yeah, I totally agree, James. If an active manager failed to include the Magnificent Seven in their portfolio, there's a good likelihood that they will have underperformed.
So now for lesson number 11, diversification is always working. Sometimes you like the results, sometimes you don't. This gets back to what you were mentioning earlier, François, about the outperformance of the U.S. equity markets, their overperformance relative to Canadian, international, developed, and emerging markets over the last decade, and especially last year, makes us question the benefits of diversification. That said, if there's always going to be a sector, a country, or something else that outperforms your portfolio in any given year, like Larry Swedroe says, and I quote, the noise of the media will then test your ability to adhere to your strategy.
Yes, and when that happens, when your discipline and patience is being tested, remember the reasons why you have properly diversified your portfolio in the first place. It's all about reducing risk without reducing long-term expected return. Even in a year like 2023, a U.S. equity investor could be unhappy if he didn't have all his eggs in the Magnificent Seven. So finally, lesson number 12, great innovations are not always great investments.
Well, for that lesson, Larry Soedro highlights the debacle of some high-profile companies that were once looked upon as pioneers of innovation. And he goes on to list some of those companies, but closer to home, I have a great example of this lesson. And you only need to go back to 2018 when the federal government legalized marijuana. Remember that, François? And
Yeah.
everybody wanted a piece of the action, but most investors got burned. And that said, we looked at the marijuana life science ETF from Horizon, and that was launched in the craze of 2017, and never had a calendar year since of positive performance. Its annualized performance since inception is negative 16.21% per year as at January 31st, 2024. So it's been a disaster for investors. Great for investment bankers who made all those fees bringing them to market at high prices.
This is incredible. I was not expecting that at all. History is full of anecdotes like this. We must, however, learn from them and be cautious when the next investing fad comes along. To conclude, I think that all the lessons that Larry has shared in his article support what we believe as part of our investment philosophy.
Well said, François. I would like to remind our listeners that in last year's podcast on investing lessons of 2022, we highlighted that no one can forecast the future, and we recommended that our listeners avoid paying attention to all of the 2023 forecasts and outlooks. It's safe to say with hindsight that has worked out well for investors that ignored the noise in the financial press and stayed the course for the full year. Investors are conditioned to believe that financial experts can forecast the future. The investment industry actively promotes this.
Yeah, I think it would be useful, James, to repeat a quote from Morgan Housel, the author of the book, The Psychology of Money. It is also from last year's podcast on investing lesson of 2022. Pessimism always sounds smarter than optimism because optimism sounds like a sales pitch, while pessimism sounds like someone trying to help you. The future is uncertain, therefore it's scary.
So a look back at recent market history makes a case for sticking with the plan, François, right? Handsome rebounds like we saw in 2023 after steep declines like we had in 2022 is a very powerful reminder that investors must remain disciplined and focused on the long term and avoid being deterred by the short-term noise. This is the only reliable way to capture the long-term benefits of being invested in the capital markets.
Yeah, totally. And we also remind our listeners, James, that they should have an investor mindset and continue to buy and hold investments with an owner's mentality. That's our mantra.
Absolutely.
Okay, now for our next segment of the podcast, we'll review a book that we highly recommend for all our listeners. So, James, would you like to start?
Sure, François. Okay, so, every year we do this. A couple of years back, we had Adam Tooze's book Crashed on the 10-year anniversary of the global financial crisis. This time around, we have a book called The Price of Time, The Real Story of Interest by British economic historian and financial journalist Edward Chancellor.
So, James, why do you feel that this is a must-read for our listeners?
Well, François, I really enjoyed this book because it lays out the economic history of interest rates. More specifically, it addresses a key investment theme in current markets, that is how artificially low interest rates over the course of human history have inflated all sorts of asset classes. As our listeners are well aware, since 2008, we have been in an ultra-low interest rate environment that ended in 2022. During this period, many asset classes became wildly overpriced. In this book, the author says, and I quote him, "Never before in history has so many asset price bubbles inflated simultaneously." Mm-hmm. This book is a masterpiece on the topic of interest and rates over the history of human economic activity. He develops the thesis that interest rates are the most important signal in a market-based economy. It's the universal price affecting all others. He affirms that interest is best defined as the time value of money. It is the price that informs every key financial decision: saving, spending, and investing.
Yeah, we have been saying this a lot in the last 18 months on our podcast. Current much higher interest rates are normal, and investors should not expect we will return to ultra low rates we experienced between 2008 and 2022. That is unless there is no other major economic or geopolitical shocks that we cannot foresee.
So again, that's why I find the book so compelling. And I should mention, The Price of Time was a recommendation from Larry Swedroe last year. So let me share an interesting passage in the book, François. After 2008, the author states, central bankers pushed interest rates to their lowest level in 5 millennia. And remember, we're almost at zero. Mm-hmm. And the move seemed like a success at first. Averted deflation, averted mass unemployment. But behind this immediate result lurk structural problems that the central bankers left to fester. Low rates have compounded our current woes, the author says. These include the collapse of productivity growth, unaffordable housing, rising inequality, the loss of market competition, and as we may all feel right now, financial fragility.
Yeah, I totally agree with his thinking. Artificially low rates distort the decentralized decision-making process of a market economy.
Yeah, absolutely, François. Without interest, the author Chancellor writes, capital can't be properly allocated and too little is saved. Investors accept more risk in pursuit of higher returns, making future growth seem more attractive than current profits. And because interest is one of the chief costs in finance, low rates shift economic activity from real world, this makes real economic sense, to purely financial transactions.
Yeah. The Boston hedge fund manager Seth Klarman has stated, the idea of persistent low rates has warmed its way into everything: investor thinking, market forecasts, inflation expectation, and valuation models. Now we have investors and borrowers thinking current rates are too high. We have said often on our podcast that these are actually normalized rates, and as a result, capital can now be allocated more efficiently.
I completely agree with you on that, François. Efficient capital allocation discipline is really, really, important to stable long-term growth in our economy. Mm-hmm. For our listeners, I would like to share reviews from a couple of very influential thought leaders we follow in the investing world. The first one is William Bernstein. He wrote a review in the CFA Institute blog.
Yeah, for a listener, William Bernstein is the author of the classic must-read 4-Pillar of Investing, which he updated in 2023. We will review this book in a future podcast.
William Bernstein loved this book, François, and he recommended it as a must-read for students of economics. And I'm going to quote him. Perhaps the book's most profound observation about low interest rates is that while their salutary effects on asset prices are plainly visible, the newly wealthy are far slower to perceive that the same thing has happened to the present value of their liabilities.
Yeah, Bernstein also says that one of this book's joy is it's relevant to both political policy and personal finance. He does not, however, develop the theme in his book.
Yeah, it's too bad because that's our turf. So it's an area we should look to develop, François. The second review of this book that I read was by Howard Marks. Now, Howard Marks is a co-founder of Oak Tree Capital Management with 189 billion USD of assets under administration, and he's really an expert on high yield distressed debt. He's famous for his memos. And his most recent memo is titled Easy Money, and he released it January 9th of this year. And so it's not really a book review, but he's extensively quoting it because this hammers home that his beliefs as well that are consistent with what the Chancellor writes in the book. And he's addressing the topic of ultra low interest rates and their impact on economics and investing.
Yeah, Howard Marks is widely read by investment professionals and known for his memos that he publishes multiple times per year.
I should point out, François, again, that it's not a book review per se, but his memo was heavily inspired by his reading of the book. And again, I'm going to quote him in the memo. What I so enjoy about Chancellor's books, and there is a first book that Chancellor wrote 23 years ago about speculation, and so he's referring to both of them, is the way they illustrate the tendency of financial history themes to rhyme, and thus how behavior that took place 200 100 or 400 years ago is being repeated today and is sure to reappear again and again in the future. What he tells is a never-ending story.
Yeah. And he goes on to say the lessons from the past periods of easy money usually fall on deaf ears, since they come up against ignorance of history, the dream of profit, the fear of missing out, and the ability of cognitive dissonance to make people dismiss information that is inconsistent with their belief and perceived self-interests. These things are invariably enough to discourage prudence in times of low interest rates, despite the likely consequences.
So again, behavioral economics is about how humans interact on their economic decisions, and so this is all part of a consistent theme that we talk about. So let's getting back to Howard Marks. He then goes on to address the key question all investors are now asking: will we go back to easy money? And I'm going to quote him again. He says, "I want to answer the one I'm asked most often these days. Are you saying that interest rates are going to be higher for longer?" And I'm still quoting him. "My answer is that today's rates aren't high. They're higher than we've seen in the last 15 years or so, but they're not high enough in the absolute or relative to history. Rather, I consider them normal or even on the low side."
Yeah, I find it interesting that he goes back to the late 60s. I quote him, "In 1969, the year I started work, the Fed funds rate averaged 8.2%. Over the next 20 years, it ranged from 4% to 20%. Given this range, I certainly wouldn't describe 5.25% to 5.5% as high." That's the rate we have right now. "Between 1990 and 2000, which I considered the last roughly normal periods of rate, the Fed fund rates range from 3 to 8%, suggesting a median equal to today's, like I mentioned, 5.25% to 5.5%.
So it's pretty clear to me, François, Howard Marks is in the camp that today's rates aren't high, and he has another great quote in his memo, and it's from the author Mark Twain, and he says, "One of the quotes I return to most frequently is Mark Twain's purported observation that history doesn't repeat itself, but it often rhymes. Mm-hmm. For investors, cycles, along with their causes and effects, are among the influential matters that invariably rhyme from one period to the next."
So, The Price of Time, The Real Story of Interest by British economic historian and financial journalist Edward Chancellor is really an essential read for serious investors who want to understand with a very long-term perspective how interest rates work and how critical their levels are for sound economic policies to work their magic.
I could not have said it any better. Thank you, François.
Thank you, James, for sharing your thoughts and expertise.
My pleasure, François.
So that's it for episode number 60 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on March 14th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.